Right, Shankar Sharma is ready. Shankar, should I start with good morning, good afternoon, or good evening? Because I don't know which geography you're joining us from. Sometimes it's Dubai, sometimes it's India, and sometimes places which I can discuss on TV.
What?
That's correct. Yeah, so I think it's still morning in Dubai.
All right, so joining us from Mumbai. Dubai, right?
Yeah, Dubai.
Dubai, yes.
Okay. Unusual choice of t-shirt. Either has to be red or green, but yellow means that not here, not there. Is that kind of a market we are in? Not here, not there.
Yeah, you can call it the midpoint. So it's a very boring sideways market. I mean, it might look exciting because it's been down from the peaks a bit, but it's been a very slow grinding fall most of the time. So yeah, it's been quiet, and I think quiet is good. I mean, there's no reason to come to market for excitement.
Shankar, the big question which perhaps everybody wants to understand from you, and you're someone I distinctly remember, was one of the first market, market observer who came out in 2008 said that look, there is a problem in the world, sell everything and get out. The given what's happened to SVP, parallels have been drawn between 2008 and 2023. Is there similarity, or this is just a fiction of imagination?
So 2008 was the first time we saw a banking crisis in living memory of that order. I mean, there can be routine failures in India too. In 2000, Global Trust Bank failed. In I think 90s, also a couple of banks failed. Those are individual events, and in the US, there have been a lot of bank failures. You know, there are community banks. US is a huge country like India. There are small banks serving a local community. They keep going bust if you look at the data. But 2008 was a complete different animal in which there's a large scale collapse of the financial system itself, not just lending banks, but investment banks and brokers and everything. So right, everything from Merrill Lynch to Lehman to Washington Mutual to AIG, which was an insurance company. So it was a completely different order of magnitude. This is compared to that, we would take this any day, the SVP or the signature bank collapse. The other thing is regulators learn to act very quickly. There is always learning in with a new event. So 2008 will not get repeated by any stretch. I mean, let's not even start thinking like that.
So, can I safely say, Shankar, that from an Indian stock market investor, this is passe now. The storm has come and gone. This is not like tip of the iceberg, which will have a snowball effect.
I completely agree with that. I don't think SVB is the problem. If you want to look for problems, the problems may well be more internal to India than an external shock like a large scale banking contagion in the US. I mean, that will have its occasional day in the sun, but that's not the reason why India has underperformed this year. I mean, that's a complete different set of reasons altogether.
Bigger problem for Indian markets, in a sense, this year has been what's happened to the Adani group of stocks. Now that deleveraging has started, the promoter has released their own pledges. There's a big white knight who's come and invested $2 billion in Adani group of stocks. Do you think from a market standpoint also, is it time to move on?
I think Adani was a non-issue for any serious investor in the stock markets. I mean, we made it an issue beyond what it deserved to be. It's a large group, but still one group, and one group cannot be said to be representative of the entire market, no matter which group that is. I mean, we've had governance problems with Infosys. We've had governance problems with Reliance. I mean, and not one, but I mean, I think maybe a dozen of them. SEBI has passed orders against Reliance promoters, against Mukesh Ambani or against Reliance company or group companies. Sun Pharma, marquee company, has had series of problems in the last 3-4 years' time. None of that has been represented in the public eye as if that is going to dent the image of India, or it's an attack on India, or I mean, that's all complete and total nonsense. This is a group problem. The group is dealing with it, and more power to them. They are important for the growth of certain parts of India, which is the infrastructure part. And I hope and I pray that they come out of it. But to extend that to say the market is going to suffer because of that is, I mean, that is a complete non sequitur in my view. Again, I say these are all, we draw false positives and false correlations and causalities. Adani Group or SBB was not the reason why the Indian markets have been somnolent in the last 2 or 3 months' time. The reasons are more internal. The reasons are that there is a slowdown in the economy based on the GDP numbers that we have seen. The markets have been sensing that. And I speak to companies all the time. And right after Diwali, from Diwali onwards last year, I started to get a sense that there was a slowdown in spending. Rural has been hurting in any case. It was urban spending which was propping it up, and that's also started to slow down. So that is where the market started to get a bit jittery about numbers, corporate growth, corporate earnings growth. It's not Adani, it's not a foreign bank contagion.
Shankar, just taking a leaf off from your latest tweet, saying that some of the yields available in fixed income and financials in the US are looking simply mouth-watering. Do you think the fact that fixed income is giving you more, better or more assured returns than equities is going to make the attractiveness of equities as an asset class, shrink in the near term?
You're 100%. I am assuming that's Aisha. Okay, wait.
Yes.
Yes, hi, sorry. The screen was minimized. Right, yes. Hi, Aisha, morning. You're absolutely spot on. I think that is the competition for the market, is the fixed income part. It's a much detested cousin because all of us are equity guys. We don't like fixed income in most part. But it is providing in India and globally some amazing, returns. I mean, in the US, like I tweeted, you can buy good quality bond ETFs for now for about 5%, 5.5%, 6% yields, even 7% yields. Real estate investment trusts are like 9%, 10%, 11%, 12% yields. In Singapore REITs, you can get, fairly decent yields. So in India, the yields are really mouth-watering to say the least, which provide you low volatility returns for an average investor. So it is, again, that is a good reason to attribute for the equity markets underperformance in India. Adani or the foreign bank thing are all just very temporary phenomena. It's more fundamental, which is that rates are very attractive and people are at this point choosing rates over fixed income over equities. And again, I go back to my point that the economy being what it is, my belief is you're not going to get a broad bull market. I don't think any of us should hold out hope that we are going to see a broad bull market in India, that is, anytime soon. We are going to see very patchy markets in which a reasonable part of the markets will be flat or even down, while small pockets of stocks, whether in the Nifty or below the Nifty, will be doing well. And that's really the skill of your investment acumen will be tested in this year.
Hi there, morning. So in light of that, what do you believe investors should be doing, or where is it, do you believe, that will be some of those small patches of outperformance or good performance? Would you say one can look at themes like for instance, the private banks, the CapEx theme, defense as a space?
None of the ones that you mentioned I like, because, all of them are private banks or banks in general, I don't like. I've not liked them for a very long time, save for maybe 2 or 3 of them. They have their occasional moments, but by and large, it's a problematic industry because of the basic structure of the business itself. And that's exactly, by the way, what happened in the Silicon Valley Bank, that while they had problems on the balance sheet because they were exposed more, obviously everybody was exposed to low interest bearing, bonds. And when they rose, they had to market, and we know all the story. But the reality is that all banks are like that you have, your investment book in these kinds of securities, which have big interest rate risk. And sometimes you hedge them. Sometimes you want to play the game of not hedging and capturing the unhedged returns. That's all treasury management, which sometimes can go awry, which it went in the case of Silicon Valley Bank. But the larger problem is this: any bank which faces large-scale withdrawals will go under. Any bank. It could be ICICI Bank, it could be any bank. And we saw 2008 being a moderate run on ICICI Bank when Mr. Kamath had to come out and assure investors and depositors on television several times. So any bank can go under because no bank keeps enough cash to satisfy all deposit holders. And Silicon Valley Bank was a particular example of a very narrow set of depositors. But I'm saying banking is a problematic one. In the economic environment I see for India, I'm not going to go out and risk my money on leveraged companies, whether they're banks or not. So the opportunities still lie in the small cap space. I mean, again, I am a big votary of that space. I'm sure it's no surprise to any of you, but I continue to remain hugely optimistic and bullish on the outcome and outlook for small caps. I mean, there are any number of good companies, again, very reasonable valuations, and they have not actually fallen much in this correction also, which again tells you that the tape is very, very favorable to small caps.
I know, Shankar, you're not going to give us names, but at least give us the themes that look attractive within small caps, as diverse the universe is.
Okay, Aisha, I'll give you one name without the name. Okay, but that'll help you because all of us are aging and we need collagen, right? It's good for the hair, skin, bones, everything. So there is this company I discovered last year. It's up 100%, which is not a lot. I think it can go a lot higher. And, still very undemanding valuations. Fantastic numbers, great ROE. And again, I think a teen kind of multiple. So there are, if you work hard, and I've been working hard on this by having meetings on Sundays with companies, let alone on the weekdays, because out of this rubble, again, which we are seeing in the market, exactly the same thing, the same movie was played last year in March, exactly around the same time when the Russia-Ukraine war erupted. The market sold off. It was a fairly brutal sell-off, as you all may remember, right up until I think May and June. And in that period, I built a portfolio, a new portfolio, apart from whatever else I held, which I was looking at just in the last couple of weeks. I mean, the performance has been fantastic. I mean, they are up on the average 100, 150% from last May or June up until now. And I think we are entering a similar phase when we pick wisely and then we sit and relax and, enjoy life. I mean, we go off-roading, we go biking, and we do whatever you want to do. So this is that period. Exactly the same time last year was that period too. So utilize this period instead of despair. Be positive. You will find fantastic bargains. Build another portfolio two, which will help you, through the next 1 year at least, as it has helped me.
It's actually not too far away from its 52-week low as well. 214 thereabouts is where the stock is. I did my research on what stock that is actually. We will try and flash that on your screen. Nikunj, you had some question.
No, I'm just trying to...
On collagen.
Well, not at that phase of my life right now, but yes, as India grows old, all of us perhaps scientifically it makes sense to use it. You've done some research on it already, is it?
Yeah, I mean, I just searched which stock he's talking about.
Not collagen, but the stock.
That picked up, yeah, not collagen, not yet.
Okay. Which one did you get?
Titan Biotech, right?
No.
Oh, okay.
I will tell you offline. Okay.
Okay.
Shankar, a lot of our viewers may not have the ability or they may not have the understanding of buying into small cap stocks or even mid cap stocks. What should they do in this kind of a market? For those who say, look, I want to buy few outperforming names where a 50% upside in 3 years or a 100% upside in 5 years is something I'm satisfied with.
50% upside in 3 years you're satisfied with. I think that's Nikunj, I don't know which planet you're talking about. If you
I'm being reasonable here.
I'll be a very happy man.
I'm keeping expectations low. Like they say, umeed kam rakho, khushi zyada hogi. Anything you get more than that is bonus.
50% in 3 years is 50% in 3 years अगर उम्मीद कम है boss तो I don't know or optimism किसको कहते हैं, but be that way, I think for investors, again, I keep going back to the thing, asset allocation. Don't get too exposed to equities. Despite all the last 3 years euphoria around it, equities are a difficult place to make money. And take it from me, I've done this for a very long time. And anybody who is honest will tell you that there are periods in which it's very easy when we just show up and we make money. But for larger periods, it can be a problematic period in which nothing happens or bad things happen. And we are in a period where maybe nothing happens, which is substantial. In which case, your fixed income part really helps you. And it's not an enemy, it's your friend. Treat that as a friend in your home. Give it due respect. In my view, all those assets for Indians, I tweeted this as well, that a huge exposure to real estate, gold, and fixed income is what keeps India's consumption story alive. And I hope and I pray that unlike the West, we don't become a country with 60-70% equity ownership. That would be disastrous because the volatility of equities is high. We know that. And that directly affects consumption in the Western world. We don't want that happening in India. Gold, I mean, has been fantastic in the last, 6-8 months time. And that again is going to give your, prop up the consumption. Real estate has been very strong. I hear it from real estate companies. Fixed income numbers are very good. So India, an Indian investor or householder is a very smart asset allocator. Don't change that. Don't become equity centric so much that this volatility kills you. So on your 20-30% equity exposure, which is the highest I would recommend, uh, you know, for an average person on the street, I don't think there is any other option but to go to a fund manager and give you money. And I know again there are ways to choose that. But if you're a self-directed investor, and I said this I think last year as well on your shows, that you can easily run screeners and I mean there are a lot of tools available for an averagely good investor to do as much as a professional investor might be able to do without being able to talk directly to management. Leave that aside. Other than that, all the tools are there. Work hard in this bear market. I remember I worked very hard. The hardest I worked in the last 12 months was in the period of May and June. The rest of the year was a piece of cake despite all the volatility. So it's the same principle from my experience to the guy or girls watching this. Uh, Spend time if you're a self-directed investor. Run screeners. Look at good quality companies in this phase. Build a 25 stock portfolio, and I think you'll be laughing all the way to the bank. Hopefully, a solvent bank in the next 12 months' time.
Well, thank you very much and enjoy your rest of the day. And thank you for waking up early in the morning. I know it's not your routine habit to get up early in the morning and that to join a television interview. So thank you very much for that.
Thanks for having me, guys. Bye.
What do we have?